So in this example, we're going to go through the preparation of both the indirect and the direct method of the statement of cash flows. One thing to note about the statement of cash flows is that unlike the income statement and the balance sheet, which you could prepare just by using the trial balance, you're going to need more sources of information. You, in essence, need three different sources of information. The first is comparative balance sheet. So you'll need the balance sheet at the beginning of the year, which would be the end of the previous year, and the end of the current year. You'll need the current year income statement, and then you will need the general ledger because there are details, transactional details that you need in order to prepare the statement of cash flows that you don't need to prepare the other statements. So for Vaden Company, what I have given you here is in essence that information. You have the comparative balance sheets, the balance sheet for 12/31/18, 12/31/19. You have an income statement for the year ended 2019. And then while I don't have a general ledger here for you, I do have information which I would have pulled from the general ledger, information that involved, again, specific transactions. And we will use that information as we get to it. What I want to do is I want to walk through both the indirect method and the direct method of preparing the statement of cash flows. Note that the only difference between the two methods is the operating activity section. Investing and financing sections are the same, irrespective of whether you use the indirect or the direct approach. Let's walk through the indirect approach first, because this you should have seen before, both in financial accounting and in Intermediate 1 last fall. So for the indirect approach for the cash flow from operating activities, you always start with net income, because as we talked about previously, the indirect approach in essence reconciles accrual-based net income with cash-basis net income. Over on the right of this worksheet, I've outlined the 5 steps that are involved in preparing the operating section. Let me walk through those, and then we will go through the statement for Vaden. As I mentioned, you start with net income. That will come directly from your income statement. Note that the statement of cash flows is the last statement that you prepare in your package of statement of financial statements. This is because you obviously need data from the other statements. So you start with net income. The first thing you're going to do is you're going to add back non-cash expenses. These are expenses like depreciation on fixed assets, amortization on intangible assets. It would also include amortization of any premium or discounts that you might have on bonds payable that you have on the books. Then you will add or subtract losses or gains on the sale of long-term assets, for instance, PP&E investments. If you think about it, this should be fairly logical. Let's say we sell a piece of equipment at a loss. That loss is going to run through the income statement, thereby reducing net income. But that loss does not reflect the amount of cash that we got on the transaction. The amount of cash we got is the sales price, or presumably if we sold it for cash. The loss is in essence the difference between the sales price and the book value of the asset. So a loss, since it reduced net income but did not reduce cash, would be added back to the net income on the statement of cash flows. Conversely, a gain, which would have increased net income, we would subtract from net income on the statement of cash flows. Okay. Then the next thing we're going to do is take a look at our current assets. Any current assets that decreased, we will add that back. Let's think about receivables, accounts receivable. If it goes down from the beginning to the end of the year, it went down because we collected some receivables that we had actually recorded as revenue in the previous year. So what that's telling us is if accounts receivable goes down, our collections actually exceed the amount of revenue that we earned. So cash will be higher than net income, and so we will add them back. Conversely, if accounts receivable had increased from the previous year, that means some of the sales we made this year we have not collected. And therefore, we're going to have to subtract that because in this case, our revenue exceeds our cash. This phenomenon is true with any current asset. So whether it's accounts receivable, whether it's inventory, whether it's prepaid expenses, if it decreased from beginning to end of the year, you're going to add it back. If it increased, you will subtract it. The last thing you're going to do for the operating section is you're going to deal with do the same thing with current liabilities. So you will look at the current liabilities, accounts payable, determine whether or not it increased or decreased. Now, your treatment will be exactly opposite, which makes sense because current liabilities would have the opposite impact on cash as current assets. If our accounts payable increases, we're going to add that back because that means we had some expenses during the year that we have not yet paid for. So that means net income is lower than cash. Conversely, if our accounts payable decreased, it means we paid for some stuff from the previous year, so our cash is less than net income, and therefore we will subtract it. So if you keep in mind these steps for the preparation of your operating activities under the indirect method, it goes pretty smoothly. So let's walk through this. So as I mentioned, step one, we're going to start with net income. So this comes straight from the income statement that I provided to you. Then our adjustments. The first thing we're going to do is add back non-cash expenses. The only non-cash expense that Vaden has is depreciation expense. I have laid that out, pulled that directly from the income statement. Now, it may be that you may have to calculate that. Keep in mind that accumulated depreciation changes because of the occurrence of depreciation expense. It also changes when you sell an asset. But one way you can get at depreciation expense, if it isn't broken out separately for you, is to analyze the changes in accumulated depreciation. Then we're adding that back because it's a non-cash expense. It reduced net income. It did not reduce cash. Then, as I mentioned earlier, we have loss on sale of land of $10,000. I pulled that straight off the income statement. It reduced our income, but loss did not reduce our cash. And then I went through the current assets and current liabilities. So accounts receivable, if you go to the balance sheets, you can see it increased. So I'm backing that out. If accounts receivable increase, that means we had some revenue that we have not yet collected. Inventory decreased. So I decreased by $20,000. So I will add that back. If inventory went down, that means some of the cost of goods sold that ran through the income statement this year had actually been purchased last year. Prepaid insurance went up, so we are going to decrease that. If prepaid insurance went up, it means that we paid some insurance premium that we have not yet expensed. Then we'll go to our current liabilities. Accounts payable decreased, so we will subtract that. It decreased by $5,000, which means we spent $5,000 more in cash than we incurred in expenses. And then income tax payable increased. That increase we will add back because if income tax payable increased, we had some expense that reduced net income that we have not yet paid. We will add all of those adjustments up, which nets to a positive of $21,600. Adding that to net income gives us cash flow from operating activities of $65,000. Okay, so let's look at, that's cash flow from operating activities. Let's look at cash flow from investing activities. You'll recall that for cash flow from investing activities, we want to take a look at our long-term assets. So if we look at our long-term assets, we have two. We have land and we have building. Now, land decreased by $80,000. If we look at the other information, and this is where we need that general ledger, because unlike the current assets and current liabilities, we can't just say, okay, land decreased by 80 and leave it at that, because that decrease may have been a combination of a sale and a purchase. We just don't know. So we've got to look at the detail. Now, there are two pieces of information that are important here. One is land, which originally cost $100,000, was sold for a loss of $10,000. The other piece of information that relates to land is bonds were issued at par value in exchange for land. So let's deal with the first one. Land, which originally cost $100,000, was sold for a loss of $10,000. Well, we remember the loss on the sale of land from the operating section of the income statement. And we know we added it back because that didn't reflect cash. If the land cost us $100,000 and we sold it for a loss of $10,000, then we must have collected $90,000 in cash, correct? Because if there was a loss of $10,000, we sold it for $10,000 less than what we're carrying it on our books for. Remember, land is a non-depreciable asset, so its original cost is what we would have carried it for. So if we go over here to the cash flow from investing activities, we see proceeds from sale of land for $90,000. Now, this other one, think about it. Bonds were issued at par value in exchange for land. Was that a cash transaction? The answer is no. We did not pay cash for land, we issued bonds. Therefore, we are not going to include that in our investing activity section because it would be misleading to imply that we used cash to buy land when in fact we didn't. We'll deal with that in a few minutes. The other, so that takes care of our account land. The other account, long-term asset account, is building. We can see building increased by $100,000. Again, we're going to go down to our information from the general ledger, and we find that a building was purchased for cash and no buildings were sold. What that tells us is that that $100,000 increase in the building account is totally related to this purchase of building. So we will have purchase of building, and notice it's a negative $100,000 because if we bought the building, that's a cash outflow. The proceeds from selling the land is a cash inflow. Those are our only two long-term assets, so that's it for cash flow from investing activities, and you'll see we have a net outflow, a negative of $10,000. The purchase of the building minus the proceeds from the sale of land. At this point, I'm going to stop this video. We will finish this example in the next video.